Great. Thank you so much for everyone joining us today. Um, we are excited for our next session, which is strategy and objective setting for ESG related risks. We have the Center for Audit Quality joining us today and sponsoring this session. We have Desiré Carroll. She is the Director of Professional Practice for the Center for Audit Quality, as well as Marc Siegel, the Assurance Partner for Corporate and ESG Reporting, thought leader from Ernst Young. Desiré?
Great, thank you, Florence, and good morning, everyone. It's great to be here and very pleased to be joined by Marc Siegel from EY, so thank you for joining, Marc. Just so I'm not sure what's been shared in advance, but just so you know, the format of the session for this particular session will be Marc and I will have an initial discussion covering some relevant points, and then once we're done with that, we will go into breakout rooms, into smaller breakout rooms with each of you in those rooms, and we'll have some specific questions for you to consider and contemplate and discuss in those breakout rooms. And then we'll ask that we come back together and we'll kind of debrief and hear what you discussed in those breakout rooms and kind of wrap up the session, have a bit of Q&A and wrap up the session. So just wanted to provide that to the extent you weren't already aware of that. So maybe before we even kick off the session, Marc, I might just hand over to you just to share a little bit more about yourself and your role at EY.
Sure, thanks, Desiree, and thank you so much for asking me to be here today. It's a great fun to be here. So my background is kind of varied. I started off as just an accountant and auditor, but I've done my formative years were really as an investor. And what I used to do as an investor was help buy-side managers, mutual funds or hedge funds try to understand what was in the back of the financial statements by deeply reading the footnotes and providing indications about some implications of what we found in those footnotes. And as a result of that, I got onto the Financial Accounting Standards Board as an investor representative. And so I was a board member at the FASB for 10 years, 2 terms, ending in 2018, and joined Ernst & Young after that. And now what I'm doing is really broadened beyond financial reporting into all kinds of corporate reporting, obviously including ESG. And I help clients with their corporate reporting sort of writ large, whether the disclosures are inside or outside the financial statements, helping them make those disclosures as effective as possible for the investor audience. I was also lucky enough in 2019 to be appointed to be a member of the Sustainability Accounting Standards Board, or SASB.
Great, thanks, Marc. It's this helpful background to have to enter this discussion. So, as many of you know, the interest in ESG reporting in the US has been gaining significant, interest and attention, specifically by investors, regulators, and a number of other stakeholder groups. And so, kind of, with this growing interest, we at the CAQ undertook an analysis of S&P 500 ESG reporting earlier this year. We looked at the most recently available public ESG reporting by the S&P 500 companies as of June. And what we found there was that 95% of companies were disclosing detailed ESG information, be that on their website or in a separate sustainability report. And then of those remaining 5% that didn't have that detailed reporting, the majority of those had some level of policy information available on their website. So, by far the majority of companies of the S&P 500 companies at this stage reporting some form of ESG information. And so, but kind of how are companies going about doing that, right, in this kind of environment with no set standards or frameworks and things like that? So Marc, maybe you could provide us with an overview of the current ESG reporting landscape, maybe some insight into the different standards and frameworks that are out there. And also, if you could just touch on how that's all evolving.
Sure. Let me focus here on what's going on with the non-governmental players, or the ESG standard setters, if I understood your question right.
Yeah.
Since up to now, as you said, there isn't a global or national mandate requiring any specific framework. I guess hundreds of organizations and NGOs have sort of rushed in over time to fill that void with their own recommendations for disclosures or their own scoring mechanisms. But however, drilling into some of the specific standard setters, ignoring for a moment the rating agencies, we're actually starting to see a little bit more convergence in the standard setting space. Late last year, 5 standard setters, which actually shows collaboration and a path forward to help clear up what this alphabet soup is. They got together and put together a framework of an analysis to say that they're going to work together more. And so actually they followed that up in June of this year. The Sustainability Accounting Standards Board, the SASB, which I'm a part of, merged with the International Integrated Reporting Council, IIRC, forming what's called the Value Reporting Foundation. And so they're in close partnership with the other players in the space, like the International Financial Reporting Standards Foundation, the IFRS Foundation. It's evolving quickly. They actually just released a statement saying that they're going to make an announcement tomorrow. And you know, it's likely that they are going to launch from the IFRS Foundation a new International Sustainability Standards Board, ISSB, to set up IFRS sustainability standards. So, you know, there's a lot going on. Things continue to develop rapidly. It's important to think about, when you think about all these different players, who their audience is, and that's one of the things that helps differentiate between the two. SASB is focused really on the investor audience. Global Reporting Initiative is another example, focuses on investors, but also the broader stakeholder group. So they're complementary. So that's just a little bit of a background of that outfit that we call it, of the international standard setters.
Thanks, Mark. That's helpful. And just, you know, even drawing on some of the analysis that we did at the CAQ, we kind of, as part of that, we took a look at what reporting standards and frameworks companies were referencing in their reporting, so in their ESG, the sustainability reports. And what we found was, so a number of companies making use of a number of the frameworks, just as you alluded to them being complementary in nature. Many of them are complementary in nature. So what we found was 362 companies of the S&P 500 had referenced SASB. We had 328 referencing GRI. We had 239 referencing the TCFD recommendations, that's the Task Force on Climate-Related Financial Disclosure recommendations. And we had 13 referencing integrated reporting, the IIRC framework. And then we also just had a look at how many were referencing CDP. And so we had a large chunk, 371 companies referencing that. So, you know, just giving you a little feel of some of the data behind that. And then also, you know, I'll also just share that in terms of the use of these frameworks in conjunction with one another. We found that, so those 5 different standards that I mentioned, we had like 146 companies, or 29%, mentioning that they use 4 out of those 5 frameworks kind of in conjunction with each other. And then we had another 28% using 3 of the 5 frameworks, and a further 18% using, you know, 2 of the 5. So, you know, a lot of, you know, complementary use of the frameworks and standards together. So Mark, we kind of, you know, we just touched now on like what the voluntary sort of reporting landscape looks like, how that's sort of evolving. Perhaps we could look now a little bit at the regulatory landscape, you know, sort of how is that evolving? What are we seeing both in the US as well as abroad in terms of what may or may not affect US companies?
Okay, so buckle up.
I know there's a lot to cover here.
There's a ton going on here. Things are ratcheting up significantly now. So yeah, let's start with the US and the SEC. As you may have seen, there's been some updates to the SEC rulemaking timeline. A proposal for mandated climate disclosures is probably expected by the end of 2021, but could slip into early 2022. And so at least for the climate disclosures, at minimum, it's expected that the proposal will include some pretty robust climate risk and governance disclosures. And it's a reasonable bet that the proposals will explicitly include requirements to disclose different levels of greenhouse gas emissions. Those are often broken down into different types, Scope 1 and Scope 2 emissions data. The SEC even might potentially require Scope 3 emissions to be disclosed too, and that's that would be a pretty extensive thing if they also required Scope 3. We expect that the SEC will probably be pretty aggressive out of the gate. They've already begun to send comment letters to companies about their disclosures and SEC filings around climate. they've even posted a sample of these comment letters on their website, which makes it look to me like they're trying to move the needle as much as they can, even before they propose the new rules. And the first point in that sample comment letter is a little bit provocative. It notes that companies often disclose a bunch of climate information in their sustainability reports, but less so in their SEC filings. And so it asks companies to explain how they considered what to put in their sustainability report versus what to put in the 10K. Now, that's not to say that every disclosure in the sustainability report needs to be included in the 10K, but it definitely should get companies thinking about how they're currently telling their ESG story across all their different disclosure mediums, communication mediums, and whether it's aligned with their overall business strategy. So that's SEC climate. In terms of human capital disclosures, the SEC is looking at that too, even though they just did it a year ago. They are looking at potentially enhancing what they did last year with a new proposal, and that new proposal is also expected before next spring. It's been an increased area of focus by SEC Chair Gensler, who's been making public comments, even tweets, about what potential topics might be in there. He's talked about workforce demographics, human capital turnover, skills, culture, health and safety, obviously, and even potentially compensation. So those two are the SEC. There'll be proposals, there'll be a public comment period, there'll be probably a robust set of comments coming back from the SEC, coming back to the SEC from preparers and investors. But I would look for new rulemaking next year on each of those topics, and they probably will be separate proposals. You asked about the EU too, and I'm glad you did, because it's a little bit of a sleeper issue in the US. And I do think it will affect companies in the US companies that actually have operations in the EU. So back in April, the EU proposed a corporate sustainable reporting directive, CSRD, that'll replace the current non-financial reporting directive that's in place right now. The CSRD would mandate ESG disclosures in management reports to the EU. It would also require limited assurance on that information, all in time for the 2023 reporting year. We don't know yet exactly what disclosures will be required. A group called EFRAG is working on those new disclosures. But what we do know is that the scope of the entities that this will apply to is greatly increased compared with the NFRD today. And they're expecting what today is 11,000 companies who report under the NFRD to go up to 50,000 companies after the CSRD. So companies, even US companies with any operations in the EU, really need to have this on their radar and take a look at it. Other jurisdictions are proposing their own regulations as well. Recently, Canada proposed to have mandatory climate disclosure and regulatory filings. The UK published a long-term ambition commitment, which includes sustainability disclosure requirements. So, a little bit what I worry about is that while there might be a little bit of convergence coming in the NGO space, the regulatory framework might still have differences depending on jurisdiction.
Thanks, Mark. That's an incredibly helpful overview of kind of that broader perspective of
A lot going on.
Yeah, so much in so many different areas. So, kind of with this growing investor demand for and use of the ESG related information, as well as these various regulatory developments in progress, what is it that companies, and in particular ethics and compliance professionals, should be doing or considering as companies determine their strategy or approach to either prepare for or enhance their ESG reporting? And I'm sure there's a lot to unpack over here too.
Yeah, there is. We were just talking about the various regulatory developments. What we've been encouraging compliance professionals is they really need to try to stay plugged into what's happening, not just in the US, but also outside the US, because there could be legal ramifications of the things going on elsewhere in the world too. And so we're actually seeing that there's not enough attention in the US being paid to the things that are going on outside the US, as it could be, as it could be, it could be impacting the US companies. So if there's increased reporting from the SEC or from elsewhere, that obviously increased risk would come from that. And so it's crucial that the entire business be involved with designing and implementing and oversight of any controls around capturing ESG data, because you have to ensure that what's being reported, irrespective of the location it's being reported, you have to make sure that that data is accurate and reliable. And so, the more confidence you have over the data, the better position you'll be in to make business decisions and mitigate risk if and when any new proposed regulation becomes mandated. And I did see a question flash about when it might be effective in the US. It's really unclear. We don't know what the proposal might be. If the proposals come out in late 2021 or early 2022, it would, if they're aggressive as they could be, like, it would be a very hard ask to have them effective for 2022 reporting year, especially for the climate. But beyond that, we really don't know. And I think that's going to be a big question in their proposals, and hopefully companies will give robust feedback to the SEC as to when they think they might be ready to actually put this stuff in SEC filings. But I want to caution against this just being seen as a complete compliance exercise. I think there's a lot of additional benefits in having strong processes and controls around the ESG data. Because if you have the effective controls in place, that'll allow management internally to not only analyze progress against company performance goals and targets, but I also think that improving the reliability of the ESG metrics can help align to overall company strategy. Because a lot of companies have their overall corporate strategy. It's not just around financial goals, it's around non-financial goals too, whether it's emissions or diversity or just building at EY, it's about building a better working world. So I think those corporate mission statements are broad. A couple other things, if it's okay. I think the question we get asked all the time is who owns ESG reporting? How do you govern ESG reporting? So I just want to mention that here too. There's really a wide range of governance structures over the ESG reporting. Historically, the finance function has been fairly uninvolved when it comes to ESG matters, but increasingly, the finance function is beginning to get more involved. The boards of these companies are looking for the finance function to get involved because of their experience with internal controls and the processes that are already in place for financial reporting. So rather than recreate the wheel, companies can leverage some of the existing systems to process, control, review data in order to integrate ESG disclosures into the work that they're already doing.
Thanks, Mark. That's great. And so you're kind of starting to talk here about things that get at accuracy and reliability of the data. And so I wonder, so as you kind of already alluded to here, an important element of enabling accurate, reliable reporting includes having basically appropriate board oversight of material ESG matters. So can you comment on what you're seeing in terms of board oversight of ESG reporting, and do you have any sort of best practices that you, as it relates to board oversight of ESG matters, that you could kind of share or reflect on with the group?
Sure, good question. I think one of the first steps we usually see at companies who are starting their ESG journey, for lack of a better word, is completing something that is called a materiality assessment, which that's what they call it. It doesn't mean material in the same financial and legal sense that we know about it here, but it's basically an exercise that identifies, out of the universe of ESG issues, which ones are the most relevant to an organization, and prioritizing that list, that subset, based on interaction with stakeholders. And boards generally try to oversee that materiality assessment. So it's obviously not the role of the board to set the ESG strategy, but rather to oversee how management creates it and operationalizes it. And in order to do that, management needs to identify the aspects that are important through that materiality assessment that I mentioned, the risks and opportunities that might exist, which then leads to the strategy that they set and identifying what goals and targets they put in place to measure progress. So in terms of how the boards are organized around ESG, that's still evolving. So for example, we sometimes see a board setting up a special ad hoc committee just dealing with ESG issues. But as things are starting to mature, we're starting to see boards integrate ESG into their committees, because ESG is really a set of business issues after all. It's not a silo. So the audit committee might get oversight over the reporting. The comp committee might get executive compensation and any ESG items that might factor into executive compensation or other comp plans generally. The risk committee would be looking at how ESG risks are embedded into the overall ERM, enterprise risk management. And the NomGov committee would obviously play a role too in many issues, including many of the G items in ESG, sometimes diversity too, which is an S issue. So overall, at the board level, ESG is still sort of a mixed bag. There's no one way to really do it.
Thanks, Mark. I mean, that's helpful. And, I participated in I listened into an NACD conference, a few weeks ago, and was really hearing very much the same thing as what you just mentioned here. It's kind of spread across various committees, each one sort of playing their respective role in the process. So that's helpful. Thanks. Kind of again, like building on that reliability aspect, one of the other things, the actions organizations take to help enhance stakeholder confidence in their reported ESG information is to subject that information to independent external assurance. So maybe I can just share a few sort of the findings that we had in our S&P 500 analysis, and then I might ask you to kind of share your perspectives on external assurance. So what we found in our analysis of the S&P 500 companies that we reviewed, we found that 264 of those companies, or 53% of the S&P 500, had subjected their ESG data to some form of assurance or verification. And then in terms of who they were looking to for that assurance service, 12% made use of an accounting firm, whereas 88% made use of other assurance providers like engineering firms or boutique consulting firms. And I guess it is interesting to compare that 12% number in the US with sort of the broader stat that you see when you look at the global level. So in an AICPA and IFAC, the International Federation of Accountants, in a global benchmarking study that they did, what they looked at 1,400 companies across 22 different jurisdictions. And what they found there was that 63% of assurance engagements were conducted by accounting firms. So it's just kind of interesting to compare, the stats in the US versus the global number. And then in terms of, what companies were seeking assurance on, like the scope of their engagement, they are fairly limited. So we found of the S&P 500, we had 100 and, as I mentioned, 264 obtaining some form of assurance. And so of those companies, 137 of those only chose to assure their greenhouse gas emissions information. And then we saw a smaller group, so 90 companies, assuring their GHG emissions, plus sort of one additional other metric that they selected. And then we saw yet even a smaller group, so 33 companies, assuring basically a multiple factors. So their GHG emissions combined with other things like waste, water, employee health and safety, diversity, inclusion. So, a number of other factors. So scope's still fairly limited in terms of, what companies are subjecting to assurance. But with that as a little bit of context, Marc, maybe I'll hand over to you to kind of share your perspectives on external assurance and what you're experiencing in the market.
Sure. Before I get to that, I'll just get to one question that came in through the chat around ESG and ERM. Again, it's a bit of a mixed bag. So I'm seeing some companies just have ESG as a silo. I don't want to say that pejoratively, but they are sort of thinking about it as ESG as one type of risk within ERM. I do see that. Some of the more mature companies in this, again, have their materiality assessment helping them figure out which are the subset of ESG issues that are really critical and important to the company and their stakeholders, and then breaking out those issues into separate places that are then embedded separately into their ERM. It's embedded into their ERM as whatever issue it relates to. That seems to be the evolving practice, whether it's the board taking the discrete ESG issues and putting them into the right places at the board, or whether it's overall ERM and bringing the separate ESG issues into their right place in the ERM, so that it's not you have an ERM system and then you have a separate ESG thing as well. It's embedded. Usually it starts off by getting embedded in mass, and then over time it gets sort of broken down and then embedded as discrete issues. So it's still a bit of a mixed bag. In terms of assurance, I think you said a lot of great stuff, Desiré, because the thing that's getting assured is also going to help you figure out who is going to do the assurance. So in the US, if you're mostly just getting the greenhouse gas emissions assured and that's it, then you don't need a big four potentially to do that assurance. You get an engineering firm potentially to do that assurance, but it's starting to broaden out. Even though it's not required today, companies are increasingly getting assurance or limited assurance over their ESG information. And, you know, again, with the CSRD in Europe, that's going to be mandated assurance. And so, you know, it's going to broaden out to beyond just the greenhouse gas emissions. You know, on a recent webcast I held with investors, the investor panelists said that it would be helpful for them to have independent attestation to verify some of the ESG data that's being reported, and you know, that just increases over time. I'm thinking public accounting firms are pretty well positioned to provide this assurance, because as assuring ESG data is not so dissimilar to assuring financial data. You have to make sure that the controls and processes are in place to allow for reliable information to flow through the system and get to the reporting. And you have to make sure that there's sufficient support behind the qualitative and quantitative measures that are being disclosed. So, you know, I think that assurance is increasing. The amount of things that are getting assured is going to increase. And I think that the use of public accounting firms with their skill sets of verifying data, understanding controls, and understanding how these things are being put together, and understanding reporting generally. I think you know, the accounting firms are going to be well positioned as this increase in assurance grows.
Thanks, Mark. That's helpful. And so I did see another assurance question kind of come in on the side here. So asking, you know, can your external audit firm assure data, or does it have to be a separate firm? So Mark, if you want to get that, you can. Otherwise, I'm happy to.
No, yeah, I mean, you know, and you tell me what you're seeing, Desiré. But actually, what we're seeing is it usually is the party that does your financial accounting assurance that is also the one that is going to do your assurance of any ESG data. And that's because you want to stay independent. You know, so if we've got a client say that we're not doing any assurance work for on the financial side, we would not do assurance work on their ESG and put at risk all the other consulting work we might be doing for that. So usually if you're in a relationship where you have the financial accounting assurance done, you're also well positioned to do the ESG related assurance by that same firm. Is that what you're seeing too?
Yeah, no, thanks, Mark. So that's exactly what we're seeing too. So, you know, it is a permitted service under the independence rules for the same firm to be providing these services. And I don't have like the stat like readily available from our S&P 500 analysis, but when we looked at that, it was by far the majority. It was really a handful of companies who weren't using the same firm actually to do that. So, you know, seeing exactly the same thing. So that, I mean, so that kind of brings us to the end of our sort of prepared discussion, and I hope we've kind of, I know Mark, you've been doing a really good job of scanning the questions, so I think we hope we've covered a good chunk of those. What we are going to do now is to break out into the various breakout rooms. We do have some specific questions for your consideration. I think they may have been pasted in the chat, and I know they will be pasted into the chat in your into your breakout rooms. But maybe just so you have an idea as you enter the breakout rooms, it's just sort of what we're thinking you could discuss in the rooms are the following. So obviously just kind of some brief introductions, and maybe kind of comparing notes on how your role at your organization intersects with ESG. So what's that connection point? And then some of the questions for consideration are things around what is your company's current state with respect to ESG reporting, and basically what's your vision in terms of the strategy going forward over the next 2 to 3 years, where you're looking to get. And as well as covering, what are some of the challenges that you're experiencing in this space in terms of the ESG reporting, as well as sort of one of your key takeaways maybe that you can take away from today's session and kind of really take back to your company. So those are some of the questions they will be listed in the description box once we break out. So yeah, and then one other thing I'll just mention before we enter the breakout rooms is we will be looking for, to get some of your feedback to share with the broader group following the breakout. So to the extent you want to just have somebody ready to share that feedback with the broader group when we get back together, that would be great. So with that, I'll hand over to our capable webmasters.